and welcome back to our first investment update for the year. This morning I'm sat here with Dan Cloete, one of our research analysts in the investment team, and we're going to talk about what happened at the end of 2023 and what the outlook for 2024 is.
Sounds
So
good.
Dan,
Hello.
good morning.
Thanks. Hi, how you going?
Good, thank you.
Cool.
Hey, so we finished the year off quite well last year. Can you tell me what happened?
Yeah, that's right. We had a really good end to the year last year in December. The world index was up 4.8% and the S&P 500 was up 4.5% across December. And that was a really pleasing way to end the year. What happened was pretty much one key event that happened halfway through December, which was the releasing of the Federal Reserve minutes from their last meeting. Those minutes revealed two important things. The first was that most board members of the Federal Reserve believe that the interest rate cycle for the US is at or near the peak of the cycle. So that suggests that there's not much higher to go. The second important thing to note was that most board members also believe that interest rates could come down in 2024. So we could start seeing some cuts as the Fed tries to stabilize the economy. Now it's important to notice the ambiguity of the language. We don't know when that's going to happen. We don't know by how much the Fed is likely to cut. They're going to be looking at the economy before they make that decision. But it was still a welcome relief for the markets to suggest that financial conditions could ease throughout the year. And it was a good rally for us to finish on.
Some promising news for homeowners then.
Potentially, we'll have to wait and see how if they actually make that decision or not at the end of the day. Yeah.
So the markets had a really challenging 2022. 2023 was a lot better. Is this a good example of staying the course, Dan?
It's a great example of staying the course, Liz. I think as an advisor, it's a great story to tell potential clients when they start to get a little bit concerned about volatility, because if you remember from 2022, things were looking pretty grim. The world market was down 19%. People were predicting a recession, a pretty hard recession. Interest rates had grown really quickly, and so people were getting quite nervous. And so, we told those in the growth funds in particular that the best thing to do was stay the course. And those that did managed to capture a really strong rebound in 2023. The world index was now up 23% for the year. And those who stayed the course would have seen a net positive result over that 2-year period. Plus, they would have been able to capture some really good bargains on some really good stock names over the course and lower the cost of their portfolio through some dollar cost averaging. So it's a great story as an advisor to tell clients that if they see a bit of volatility, it's important to stay the course because you never know what's around the corner.
And speaking about what's around the corner, what's the outlook for 2024?
So at this stage, you never know what's around the corner, but we can say that the debate between the hard landing and the soft landing is still ongoing. So advocates of the hard landings are pointing towards how quickly interest rates have risen over the past 18 months and point out that it's really difficult to balance stable economic growth while trying to bring inflation back down to reasonable levels and hiking interest rates so quickly. But it must be said that the soft landing argument is probably winning at the moment because the global economy looks really stable despite these interest rate increases. For instance, on Friday, the US released some job data that was actually a fair amount better than what economists were expecting. So we've got inflation back down to roughly 3 to 4%. You remember it was quite high in 2022, but the employment market is still remaining relatively strong. So at this stage, it's the soft landing is upon us, but we have to acknowledge that there's a range of outcomes that could happen throughout 2024 as well.
Yeah, and so what is Generate doing to position our portfolios with these conditions in mind?
Yeah, so we're staying nimble is the key here. We recognize that there are these range of outcomes that could precipitate in 2024, and we're planning accordingly. So if the soft landing continues, then we've got good exposure to really compelling growth themes like GLP-1 drugs, AI, fashion, travel, financial markets. And so if the economy remains stable, these themes should perform quite well during the year. At the same time, if we start seeing signs of a hard landing, we can quickly liquidate those positions, get more cash on the portfolio, and we've got defensive stock names ready to invest in as well. I think this is a really good example of the benefits of active management, that we can look at the various scenarios and kind of plan accordingly and respond, rather than just kind of passively sitting and waiting for things to happen.
Yeah. So what's up next for the global portfolio then?
So we're already back into it, full speed for the year. The earnings season kicks off this weekend with the banks reporting, and then in a couple of weeks we've got the big names like Microsoft, Tesla, Amazon, Google all reporting their quarterly earnings, and so that gives us an opportunity to sense how the financial performance of our key investments are going. And then on Thursday, US time, we're also getting an update about US inflation, which will tell us a bit more about whether that hard landing or soft landing picture looks more likely at this stage. So key data coming out in the next couple of weeks, and we'll be busy looking through all that to start the year.
Be interesting to hear what happens.
Fantastic, yeah.
Cool. Thanks so much for the update, Dan, and thank you for watching.
Hi everyone, just a quick update on the inflation reading that came out this morning. Unfortunately, it was a little bit higher than expected. So whereas annual inflation was at about 3.1% in November last year to finish the year, it's now just come out at about 3.4%, which is unfortunately heading in the wrong direction, and suggests that the fight to combat inflation in the US isn't over yet. And it kind of pours a bit of cold water on the idea that the Fed can start cutting rates as soon as March. Initially, the markets sold off a little bit on the news, but have since recovered as at the time of this recording, so that they're mostly flat for now, which is welcome news. And this recovery kind of suggests that the reading wasn't too bad, and that investors believe that the economy can continue to sustain higher interest rates at least for a little while longer.